So sort of like why we're talking about financing contingencies, right? For those who have been buying apartments for a while now, what you've seen is that we've had transitions between it being a buyer market and with it being a seller market. So when I first started writing contracts, you had financing contingencies in your contract, right? You submitted it. Now here's my financing contingency, and then what happened? The market got hot, and then the market gets hotter. And what started happening is that we transitioned from a buyer's market to a seller's market, right? And as it became more of a seller's market, brokers would look at that financing contingency and say, we don't want that. I'm not going to accept an offer with the financing contingency in it. Interest rates are going down, the market's going up, cap rates are compressing. I got more offers than I know what to do with. So why would I want to accept the offer that had a financing contingency in it? So what happened was we just threw it out, right? We stopped writing offers with financing contingencies, and you as a buyer was supposed to show up with enough confidence, enough skill, enough of a craft to say, I'm going to purchase this apartment complex, no matter how many millions of dollars it is. And I don't care. I'm going to also put down hard money from day one. And I don't care. I'll put it at risk because I understand what's happening. I know what I'm doing, and I want you to be confident in me, Mr. Seller. So what's happened though is that we have seen the market transition very recently. I mean, in January, February, March of this year, 2022, it still was a seller's market. Now it's starting to transition a little bit over into a buyer's market because sellers just aren't seeing things happen like that. So for those of you who are new and do not know who I am, my name is Jason Stubblefield. I have been investing in apartments since 2015. I will share my screen right now. So you check out, if you're looking at the screen share right now, you're looking at snscapitalpartners.com. If you're new to me, new to our company, snscapitalpartners.com is where you can hear about us, investor testimonials, some of the projects that we've done. Also, if you want to hear about projects that we have exciting opportunities that we roll out. And if I have an existing relationship with you on some of those, you'll hear about them. So if you go over to the Invest tab, there's a brief form for you to fill out, right? You fill out this form, puts you into our investor community so that when we have deals, you hear about those deals, you're able to find out what we're doing, find out what projects are coming, have conversations about them to see if they work for you. All right. Now back to the lesson at hand, financing contingencies, right? So setting the stage about how we moved away from that. And right now there hasn't been any formal announcement. This is some of the things that come about with just being in the industry, right? There's no formal announcement to say, hey, you got to go put financing contingencies in again. And there wasn't any formal announcement to say we had to take them out. It's just what happens because the market's changed, the market shift. Being able to understand where you are is just going to help you do that, right? And so what I've seen experience right now is that there are a lot of contracts that have been written on multifamily purchases without financing contingencies. I'm a victim of that too, right? No financing contingency on a deal that we're doing. And so what happens with that? Well, as interest rates go up, your loan proceeds can be reduced, right? Because you're buying this off of what you call a debt coverage ratio. If you aren't familiar with that, and this goes for the whole throughout the whole talk. If you aren't familiar with something, don't take time out of your Tuesday just to hear a lecture. Make sure that you're actually learning from it. So I encourage you to ask questions, anything that's unclear. But the debt coverage ratio is what lenders are going to use, and Chad, correct me if I'm wrong with this, but lenders are going to use to determine how much they're willing to lend on your apartment complex. And so it's based off of how much money you're going to have left to service the debt. And so as interest rates go up, the amount of money required to service the debt goes up. And therefore, if a lender says we only want to fund you at 75% debt coverage ratio, Well, as the pricing of servicing that debt goes up, the lender's going to give you less money. So now I said, oh, okay, well, it was 75%, or sorry, I misspoke there, right? So 75%. I'll say that again, Chad.
Like 1.25 or
Yeah. 75% is your loan to value, but they may say a 1.25 debt coverage ratio, right? And so if you have a 1.25 debt coverage ratio, that's what they want to say. There's enough net operating income right there that you got 25% cushion in order to service the debt. And so as interest rate goes up, well, in order to maintain that 1.25 cushion, now there has to be less proceeds. So that reduction in proceeds means that you have to come to the table with more money. So where they may have started at a 75% loan to value, it could drop down to 70%. It could drop down to 65%. It could drop down to even 60%. So what that means for you is that your deal looks different. Now the amount of equity that you're bringing to the deal is different. The amount of proceeds that you are getting from the bank is different. And in some cases, it makes a deal go from something that works into something that does not work. And so financing contingencies is how you protect yourself from that, the way you're protecting yourself from that volatility. Are we all following along? So look good. I'm checking. We got no questions there. Okay. So right now, let's take a brief moment to take a look at what one of these looks like. So just understanding, let me share my screen here. So right now, this is a purchase and sale agreement that I've used in the past, and there's a whole lot of information in here that we won't cover right now. But let's just talk about this clause saying financing contingency and what it is, right? This is where you're saying, I am going to purchase this property given this certain criteria, right? And if I get this criteria, I will purchase. But if I don't, now we either have the ability to terminate this contract, or we can renegotiate the terms of the contract. And so this clause right here, even though it's only a paragraph, is actually paramount right now for you trying to do deals. So let's just go ahead and briefly read through it. And I've highlighted some things that are going to be interesting, right? So purchase and seller's obligations under this agreement are contingent upon purchaser's ability to procure a commitment for a first mortgage financing for the acquisition of property in an amount not less than 75% of the purchase price. And side note, I hate lawyer speak. And it just seems like I have to like go internalize everything that I read, because it's just written in jargon that just it doesn't work in my brain, right? I'm like, what are you talking about here? But anyways, I do understand this where it's saying that I am going to get 75% loan to value on my loan. And if I don't, that's where this contingency comes in, right? And it's also saying that I'm going to get 6.5% per annum constant interest rate and 25-year amortization on or before the end of the financing period. So there's a lot of language that goes on. You put in your contract, you may want to talk about, hey, I'm going to get a loan and I'm going to have a period to secure that loan. That's what you call a financing period. And then after that, you're going to have maybe a financing contingency. We didn't in the past, but now it's coming back. So the financing contingency is where we're going to talk about the terms of the loan, and you can alter any of these things. And so how does this happen? Where do you get these numbers from? Where does 75% and the 6.5% and 25-year amortization, where does that come from? Well, you may be talking to a lender like Mr. Chad Green that we got on, or someone else, right? What I want to say, it should not come from you, right? You shouldn't be underwriting deals and just making assumptions about what the debt's going to be like. You should be talking to a loan officer that could say, hey, at this current moment in time, this is the loan to value you could get off of this product. This is what your interest rate would look like. And this is how that loan would be amortized, right? And so maybe you're doing a agency debt with Freddie or Fannie. Maybe you're working with a local lender, portfolio lender, doesn't matter. But whoever you're going to finance this deal with, you want to talk to them about how that particular financing model would work. And that is the basis that you underwrite your deal on, right? And so if you talk to a loan officer and they're saying, hey, we can give you 75% and we'll give you 6.5% interest rate fixed with a 25-year amortization, that's what you underwrite to. Now, what we do is then you want to go to a worst case scenario, right? So the deal works at those terms, but maybe things are going to shift. It can take you anywhere from 30 on the very 30 is like blazing fast in commercial real estate to actually close the deal, right? Highly unlikely, but I've heard of it being done. I personally haven't closed any deal in 30 days. But it can take you anywhere from 30 to 90 days for you to execute on a contract. 90 days can be a completely different market. Like we spoke of before about how in March, we had 3% interest rates. And now today it's looking more like 6. So you've almost had interest rates double in a term of months. And so what you want to do is talk to your lender, say, where are we going to be on our debt terms? And then you want to look for the worst case scenario. Well, how high can interest rates go and this deal still work for me? How low can my loan to value go? And then the deal still works for me. So maybe the deal works on your for your capital base at 75% leverage, but it doesn't work at 60% leverage, right? Meaning that if I have to bring 40% equity into this deal, now my returns aren't strong enough on that 40% equity to give them the 7% cash on cash or 8% cash on cash, whatever it is. So you're playing around with these numbers. And when you get to the point of writing your contract, now you're going to use the high end of these to say, this is where I want my contingencies to come into play at, right? So if you today, this contract, I mean, you could put it in here. It's very favorable to you as the seller, but it's favorable to you as the buyer. But a seller may look at you and say 75% debt, you at least got to be willing to go down to 70 if you want me to accept your contract. And they may say interest rates right now are 6% or 6.5%. I want you to, at least before I accept this, I want you to be willing to go up to a 7 or 7.5%. So all this is negotiable, but you want to look at the worst case scenario within your underwriting. Say, where does this deal still pencil out for me with no problems that I can be comfortable with if the market changes or shifts? And then that is the number that you put in here. So you have your loan to value, your interest rate that you're okay with, and your amortization schedule, right? And you've discussed this before with your lender. You feel confident in your ability to get those debt terms. And then it is on it's your duty to go out and secure that financing. That's what you're saying in the contract. I am going to make this application within, in this case, I think it's 30 days after the effective date. I'm going to show you that I'm actively looking for these type of loan terms. I want to be able to prove it. But Mr. Seller, if I don't get this, if interest rates go up and I got to try to buy your property with an 8% interest rate and I'm only getting 55% loan to value, then I have the ability to either renegotiate with you, or we have the ability to terminate this agreement. And so by putting this into your contract, it's going to allow you to sleep late at night. Those on Facebook, you may have saw the picture that I put out about this, right? You want to write offers and be able to feel confident about your offer, right? I don't want to have the struggle of understanding or the struggle of not knowing where interest rates are going to go, and that interest rates increase and suddenly I've had to have my loan proceeds knocked, right? So on a deal that we're currently doing, we had roughly like over $1 million in proceeds reduced relatively quick, right? And it's not a small amount of money. So a 0.75% interest rate hike can result in a real loss of loan proceeds to you, right? I want to say it was way over that. It may have been $1.4 million of loan proceeds that reduced. And if you're not in a position to be able to handle bringing in an extra 1.5 million, 3 million, 4 million, depends on the size of the deal, right? It can make your deal no longer work. So that is the severity of going into deals without it. And especially if you're doing hard earnest money day one, you want to have that sort of security because you don't want to lose your earnest money because debt terms have changed, right? So that's really what I wanted to share. Are there any questions about that? Any questions, comments, concerns with that? I must have.
So, Jason, thanks for sharing. So, in North Carolina, they have a due diligence money and then the earnest money. So, will you still lose your due diligence money even if you file for this contingency legally?
Yeah, so that's part of the contingency, right? Where you're saying I don't think I shared that part of it, but all of these deals you're putting in hard earnest money, right? And what you're saying in the financing contingency is if the financing terms are the reason this deal doesn't work, then I can get my earnest money back, right? We're going to terminate this contract. And now, Mr. Seller, you owe me the funds that I put up back.
Yeah, but earnest money is fine. I get it, right? It'll be returned back. But in the state of North Carolina, when you put an offer, they make you also submit a check for due diligence, and they say that's non-refundable. You go in a deal, you go in a contract, your due diligence money is gone if you back out. Now, if you put this sort of a contingency, can you? Can we get the due diligence money back? Is what I'm trying to at.
Yeah, I don't really buy real estate in North Carolina.
Okay.
And I haven't heard of that, right? So you obviously have due diligence costs, but we haven't put due diligence costs as terms of the contract. That's just the cost that you use to protect yourself as the buyer. So the due diligence cost is what you're going to pay your inspectors and you're going to have some legal costs when it comes to the contract. You don't get that back. That's money that you're just going to lose. It's the cost of doing business. But if it's in the contract, if it's in the contract, then it's negotiable. And I don't understand why you would even pay why would it even be part of it?
Yeah, it was a strange concept to me also, but it was in North Carolina. When your offer is accepted, the next day you send two checks. One is the earnest money to the lawyer, and then the due diligence money to the seller. And that due diligence money right away is non-refundable, even if you find in the home inspection or you don't like HOA documents. It doesn't matter. You put me in contract as a seller, I'm going to take that due diligence money. And if I keep the due diligence money low, especially in the seller's market, let's say I'm buying $100,000 property and all I give is $100 for due diligence. Chances are seller is going to say, you're not serious about this property. I'm not going to give it to you. I prefer like $1,000 at least towards due diligence. It's kind of different thing. I was new concept to me, and I was trying to figure out, if this financial contingencies keep me away from, can save me from getting my due diligence back. So,
Yeah. I think
I'll check with my realtor. Yeah.
Yeah. It seems something that may happen more in the single family space. And I don't know anything about a due diligence fee. You may either be talking about, that's a good comment, you may be talking about an early access fee, or you may be talking about this will happen in residential world where there will be a agent involved, and the agent is saying through your brokerage agreement that even if you don't do this deal, there's going to be the agent's basically going to get paid, right? And there may be some fee that's included into that, where you're saying, all right, even if you don't, I showed you the property, you wrote a contract, you owe me $100 or $200 or whatever it is, right? It's negotiable, right? I think it's real estate. If there's a contract, then it definitely is negotiable. So,
Right. Okay.
let's see, due diligence money is non-refundable, whereas earnest money is refundable if the buyer decides not to buy the home within the due diligence period. Yeah, due diligence cost is real cost that happens right up front. You know what I mean? You paid a plumber to come run cameras down all your plumbing lines. That plumber came out, they did the work, you're paying the money, right? You don't get refunds on that.
Mhm.
Uh,
All right, well,
so
thank you. Mano, I think that contingency is a good way to protect your downside and get yourself out of the deal if finance.
yeah. I mean, I had to go scrape dust off of that word form because I haven't used that financing contingency in such a long time. But it's coming back. I guarantee the next offer I have will have that in there. And so you still want to make your offer attractive, but at the same time you have to protect yourself. So James says, if you go from a 1.2 DCR to 1.5 DCR, would that make a difference in financing? Absolutely. Absolutely. And so you have 1.5 is going to reduce your proceeds as well. So whatever that number is that the lender is telling you they want to see as your debt coverage ratio, that is going to be the determining factor of how much money they're willing to loan on the property. So if that changes and it goes higher, now you need to bring more money. If it goes lower, now the bank will be willing to give you more proceeds. Yep. And just a side note, usually there's a maximum, right? So the bank may say maximum loans will give you 80% loan to value. But what really happens is then they're going to try to get to 80% based off of your 1.25 debt coverage ratio. And if the debt coverage or the property income doesn't support 1.25, then you may get 77% loan to value or 73%, right? It could be sort of strained. So it's not a constant though. It's not necessarily saying you're going to get 75% leverage. You can get up to 75% or up to 80% leverage based off your debt coverage ratio.
Yeah, Jason.
Yes, sir.
Yeah, let me clarify that question right there. So typically speaking, they say they want a 1.2 debt coverage ratio, right? Typically, I mean, they can ask for what they want, but I'm saying typically they say 1.2. So that means that you can pay the mortgage note plus you got 2% money sort of like in the bank, right? Right.
I'm sorry. You say that again?
Okay, so when you say 1.2, basically what that means is that one represent you paying the mortgage off, right? And that
Yeah.
2% saying that you got a 2% cushion, right?
Yes, right. It's a 20,
Okay,
it's a 25% cushion.
So if that's true, then when you do your underwriting, if you can find a property where instead of 1.2 in your underwriting, you have a 1.5 or something like that, which means that you got 50%. So how would that affect the finance?
You would get less money, right? So it's the opposite. The higher the debt coverage ratio, if everything being constant, right? So you got the same NOI, right? NOI is the same, and your debt coverage ratio now goes up, your loan proceeds are going to go down. If your debt coverage ratio went down, now your loan proceeds would go up.
Oh, I got it backwards then, huh? Because I thought that 5 represent you having a 5%, 50% cushion. Therefore, you have more money, more cash flow.
you're sort of correct, but you're thinking from the wrong perspective, I would say,
Okay.
right? So you got to think in terms of the bank. The bank saying they want another 5% cushion, right? Or 50% cushion on the debt. So now
Oh, okay, okay.
they want to lower the amount of money that you receive so that there's a larger amount of income in comparison to the amount of mortgage payment.
Okay, now, but here's what I'm saying though. I follow what you just said. What you said is that if the bank said 1.2, you need less money than at 1.5, right? 1.5, they say, okay, the debt coverage ratio got to be 1.5. So that's sort of like a risk sort of factor. I'm saying that if you underwrote, when you underwrite instead of 1.2, if you're underwriting at 1.5, that means that you have more cushion, right? I follow what you're saying. If the bank only want 1.2, if the bank
Yeah,
want 1.2,
yeah. I mean, I think I understand what you're saying, right? If you're trying to be cautious yourself, right? So you want to say, I only want to do deals with a 1.5. That's good. What will happen in that instance is that you're just going to take on less leverage, right? So you will underwrite your deal saying, probably I want to be more like 50% or
Okay.
50, 60% leverage is all I'm going to take. I'm going to replace the remainder in equity and then seeing how your deals look that way.
Okay, thank you.
Yep. Yep, good stuff. Anybody else? Questions, comments? All right. Good deal. Well, no, that's it. Like I said, it was fairly simple today, but definitely important. Hopefully at the end of this, you understand how financing contingencies can help protect you as you go out here and make offers and continue to do deals, right? I think everybody who is involved, right, is going to be cautious, but at the same time optimistic, because I think there's a lot of value in deals that can be done in this environment if you know how to structure them and if you know how to protect yourself from the downside. So hopefully you all found this helpful. I'll see you here next week. Thanks for your attendance. Make it a great day on purpose. Talk to you later.